Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
All right. Today we have Mark Khuri with SMK Capital Management coming to join us on the podcast. Mark, thanks so much for coming on the podcast with us. And we usually get started by why don't you just tell us a little bit about yourself and kind of like how you got into real estate in the beginning, and kind of what brought you to where you are now.
Yeah, thanks for having me, AJ. Good to be here with you. So how I got started, 25 years ago, give or take. I was in corporate finance for a number of years, working in a cubicle with another coworker, a lot of spreadsheets, AJ. And he pulled one up that was a pro forma of a fourplex that he was looking to buy and manage and renovate. And gosh, he had like such amazing projected returns on that spreadsheet. I still remember today. And I'm sitting there like, what is this? Can you really make that much money just by buying a property?
Is this really real?
Yeah, exactly. So that was one of my earlier memories. But yeah, essentially started investing in real estate at the age of 25. And that was 2005. And while working full time, very active real estate, AJ, buying, renovating myself, managing everything myself, and doing it after work and on the weekends, of course. So yeah, that was the early days. Partnered with my family for the next several deals after that. Brothers, parents, aunts, uncles, cousins. There's a lot of Khuris involved. That's our last name. And so we did about a dozen different acquisitions, predominantly all single family, small multifamily, distressed, buying from the bank, all cash, boarded up type houses for pennies on the dollar from what they were being sold at just a few years prior. And so by 2010, I was hooked and left the W-2 and formed our company, SMK Capital Management, partnering with my father at the time. He's since retired. Really to create syndications and funds and invest in a lot of different stuff. And so over the years, we've essentially, I think we've created and managed over 70 different partnerships with investors. We've invested in over 150 different properties across 36 states with different sponsors, operators, and also being a sponsor and operator ourselves in single family and small multifamily. So I'll pause there. Done a lot and learned a lot over the years too.
Yeah, that's pretty cool. So with the corporate finance, did that kind of give you a background into how to start setting up funds or like do the syndications? I know that, for us, we learned about syndications on Bigger Pockets, but it was like 10 years later from what you're talking about. So I'm just kind of curious about that.
Yeah, not directly. Corporate finance was a good stepping stone in analysis, budgets, planning. I was an internal auditor for several years. And so, these kinds of roles really helped with more on the spreadsheet analysis projection side, AJ. Operations, I learned a lot of that through owning and operating, 60 of our own properties over the years in multiple states with team members. And so a lot of hands-on. Through also my father was a real estate investor since the 1970s. And so it's kind of been in our family for a long time. But really to get to the answer to your question is like, how do you learn some of the technical aspects of creating a fund and managing it and syndications? It was a few ways. One, paying expensive attorneys to teach us. That's what I would call the hard way of doing it, and learning directly from the legal aspect. Which is important. Of course, you need to know the laws. You got to know how to structure things properly. And so the first, I think, formal fund we created, you had a pretty big ticket up front to get that created properly and formed. But that was, 16 years ago. And so at this point, you learn a ton through doing. You also learn a ton by investing in other operators' deals, right? And so as an LP, we've been an LP, personally in over 36 deals as well, just through my personal family investments and my retirement account as well. So
Was
there's a bit of that.
Was that something you
Go
did
ahead, sorry.
before you started doing your own funds, or was that something that kind of came afterwards?
I'll kind of share a little bit of the progression. So when we first left the W-2, we went out to our local friends and family, had them over to our home and our basement and a PowerPoint presentation and food and drinks about a blind pool fund that we were creating to basically piggyback off of what we were already doing as a family for the last 5 years, buying some of those deeply distressed assets I mentioned earlier. And so that essentially was our first formal capital raise, AJ, in our basement in upstate New York, where I'm originally from. And it didn't go great, to be honest with you. We didn't raise that much money. And it was 2010. So I think a lot of people were just,
hesitant.
The world was upside down, right?
Yeah.
So, but we dove in and we just kept going. But we were essentially an operating partner for 7 years from that point till 2017. In all of our deals as, picking the paint colors, financing, determining when to sell, when to refi, managing everything from A to Z. But at the same time, the reason why I mentioned this, when I left the W-2, I had a 401k sitting idle, and I transitioned a lot of those dollars into a self-directed IRA. And I started networking my tail off. Back then it was all in person. There wasn't really Zoom, and the Jobs Act hadn't passed yet. And so you had to shake hands and listen to people speak. And so I had notebooks full of notes of information and just a sponge for learning and education. And that was a big part of, hey, I want to invest as an LP some of my retirement dollars into these other real estate sectors that we're not experts in or don't necessarily know how to operate. For example, mobile home parks. We started investing as LPs in mobile home parks in 2012. And then it kind of just spiraled from there. We made over 20 LP investments over the next few years into a bunch of different real estate sectors, oil and gas, senior housing, student housing, vacant land, promissory notes. Tried a lot of stuff while being an operating partner and essentially determined, which lane we want to focus in. Where's our specialty? Where's our risk reward profile that we're really comfortable with, that we think can provide our investors with great returns, but, essentially lower risk than some of the other areas we tend to avoid.
Yeah.
So it's a lot of process of trial and error and education along the way.
So what I'm hearing is you kind of spread out far and wide and kind of figured out like what it is that you're good at and then double down on what you're good at.
Yeah, I mean, by 2017, we decided, hey, let's look at the risk and reward of these investments we've been making as a family into these LP deals versus our GP operating partner investments. And we found, and again, we were in single family, small multifamily as a GP, and the window for deep discounts was closing. We saw that coming for a couple years, and we kind of knew that single family historically has been more correlated to the economy than some of these other sectors. And so we essentially asked our investors, like, hey guys, here's what we've been doing as a family. In addition to the deals you're invested in, we've also been investing in mobile home parks, self-storage, some industrial, these other sectors. Are you interested in diversifying, getting access to these as well? And everybody pretty much said yes at that point, AJ. So we pivoted and started more syndications where we partner with other sponsors and operators that are specialists in one real estate sector and raised capital in a fund or syndication style where we manage all of our investors, their distributions, their K1s, their tax returns, the quarterly updates, bookkeeping. We do everything in-house, but operations is on our operating partner side for those deals. And so our investors knew and liked and trusted us and essentially stayed with us, and we manage everything for them, and they still communicate directly through SMK versus having all these operating partners that they have to learn about and know, like, and trust, and of course.
Well, and it sounds like they trust you to go and vet these other sponsors and talk to these other sponsors and do all the due diligence around making sure that, they're not going to walk off to Mexico with your money, right?
Exactly. Yes, that's a big part of it. We've seen a lot and done a lot. We've got a lot of, pretty intricate processes and systems in place to make sure we're picking the right people and the right deals. Whenever we can, of course, get a special kind of situation where, honestly, like, just to be frank, we look at about 600 to 700 different investment deals a year, all in real estate. And we invest in maybe 1% or so, AJ. And so it's saying no all the time and then just trying to find those, handful of deals that kind of, you just say, wow, I need to learn more about this. Like, this is one heck of a story. And look at the risk reward profile on this versus the other one. It's got to have something unique. And so that's what our investors are relying on us for, is to find those special deals.
Yeah. And I'm not sure I exactly heard, but like, I think you said you started creating these funds and it didn't go well raising money back in the bottom or the basement in New York. Like, kind of tell me a little bit more about how that progressed.
Well, I mean, we started out with a blind pool fund, which is very hard to do in 2010. It was a thesis, right?
Well,
hey guys,
it's pretty hard. It's pretty hard to do if you don't already have investors that have like senior track record and know and like and trust you. Like, they're like, wait a minute, you want me to just blindly invest in what you're doing? So
and that, yeah, exactly. But we dove in head first, I like to say. And so that's what we started doing, because we were already buying specific property type in a certain location where we had a team on the ground and we had some case studies, but it wasn't a fully established 10-year runway profile, track record, et cetera. But that's how we got started. We basically said, hey guys, we're going to kind of repeat what we've been doing already, and you guys want to come and invest with us, and created that fund, which, again, legal docs, operating agreement, formation, all done through quite expensive attorneys at the time. And you kind of just snowball from there. You do another, do another, do another. We've created 70 over the years of those different types of entities and different investments and grouping of investor capital to go and invest in real estate.
Nice. And so, I mean, in some aspect, what you're talking about is, so you create a fund and, have multiple investors invest with you, and then you use that essentially capital to invest in multiple different sponsors, or do you do it just for a single sponsor for a single deal? I mean, I think that this is like the fund of funds kind of model, from what I understand, but maybe for our listeners, why don't you give a definition of what you believe the like fund of fund model is and how it works?
Yep. So essentially, fund of funds is where investment manager, let's say it's us, SMK, creates a special purpose vehicle, an LLC, where investors will invest into that. And that LLC has its own operating agreement, its own PPM, its subscription documents, bank account, tax filing, you name it. That LLC will then go and invest in other LLCs, other operating partners deals, as either an LP, GP, or a JV type agreement. We're almost always negotiating better terms from our operating partners, AJ, than what an investor would get on their own if they went direct to any one of those deals. And so the economics have to make sense, net to the investor, because SMK, or the fund manager, fund of funds, is obviously not doing this for free. There's going to be a split into some type of promote structure in addition to the GP's profit share split as well. And so got to be careful of fees. If you're an investor, make sure you're very much aware of how the net return is being calculated to you. And from there, we essentially, what we do today, AJ, and have been for many years, we don't create a blind pool fund anymore. We did that once and we learned our lesson. Not the best way to do things. So we will create a fund when we see 2 or 3 investments that we really like and want to invest in right around the same time. And then that'll snowball. So for example, we just recently closed our alternative fund 4, which was opened 12 months ago. And we, at that time, when we opened this fund, AJ, we had identified 3 investments that we wanted to invest in. One of them was fixed income debt fund. Another one was a mobile home park. income and income and growth. And then the third one was an industrial portfolio. And so we put those together, launched our fund, started raising capital. So that way investors knew, hey, you're already going to invest, your capital is going to be spread across these three first deals. And then over the next 6, 9, 12 months, we're going to keep the fund open and we're going to continue to raise and deploy into what we hope to be more amazing deals that we can source and find. And that way, an investor's capital is spread across all of the deals in the fund. And they get diversification, income, growth, tax advantages. They can avoid high minimums because we're aggregating capital. And, we do the math, like if somebody had access to all of the deals in our fund today, there's 9 of them that we invested in, AJ, over the last 12 months.
Okay.
They would have had to have, 1.2 million just to hit the minimums on each one. So that's kind of how we look at it. And essentially our investors rely on us for quarterly updates, communication, progress reports, tax returns, distributions, K1s, you name it. They just deal with us and not all of the 9 operating partners.
So they get a bunch of the benefit of diversification in the investments without the kind of essentially initial upfront capital. And then also without the initial like upfront due diligence. Like you guys are really doing all the due diligence on these sponsors. I mean, you talked about, back before Zoom, you were shaking hands and doing that marketing. Like that's a significant amount of knowledge that you've acquired over the years. That if someone's a doctor's, working 40, 80 hours a week or something like that, they just don't have the time to go do, nor necessarily do they want to, right?
100%. I mean, all of our investors are passive. They're busy. They've got too many things going on in their lives. They want a portion of their portfolio to be allocated with a fund manager that knows the space really well and can, of course, vouch for investments, do enough due diligence where we're passing on almost all of them and just cherry picking the few that we think have a high likelihood of meeting or beating the projected returns. That's always the goal of any due diligence of any investment that you're going to make. And so that's what they rely on us for. It's very passive for them and essentially providing them an investment vehicle that they, can't create on their own and maybe don't have access to most of these deals either as well. I mean, some of them are relationships, right? AJ, we've been in the business for 16 years formally. So a lot of our deal flow is, hey, Mark, we got one in LOI. Take a look at a pro forma. Do you want to jump on a call next week? Tell us what you think if you guys want to get involved. That kind of relationship really is where we get a good number of our deals from.
Yeah. I mean, as a sponsor ourselves, I'd much rather just come to one person and do a JV partnership on a really good deal as opposed to talking to 20, 30 investors. So I understand where the benefit comes in. Can you talk a little bit more about, I mean, I get that, the minimums is kind of a hurdle for investors, but with investing more money from a fund with a sponsor, you said that you get some other, I guess, kind of benefits or preferred pricing. Like, can you expand on maybe, not exactly, but like kind of a range of what that maybe looks like?
Yeah, I mean, it's essentially over time, relationships are formed with other operating partners where we are, investing multiple 6, 7 figures with them, right, AJ? So they look to us as more of an institutional partner that is going to deep dive on due diligence much more than any individual investor would do. At the same time, write a bigger check, right? That's just be transparent. That's how we help our operating partners.
Yep.
So for doing so, we're often able to negotiate more favorable terms than what an investor might get on their own. So I'll give you an example. One of our operating partners, really good at what they do, mobile home parks and self-storage. They've got almost $1 billion on assets under management, AJ. And they provide their investors a 7% preferred return and a 60-40 split above that. We negotiate a 9% preferred return and an 80-20. And so that's what our fund receives. And then we add in SMK again isn't doing this for free. So our investors at SMK's entity level will get an 8 or 9% preferred return and a 70 to 80% profit split above that. And so the net return to our investors is the same, slightly better coming through SMK than what they would get if they went direct to the operator. So that's one example. Sometimes we will negotiate lower management fees. Sometimes we'll get favorable voting rights depending on how much equity we are for the whole deal. We might have the ability to say yay or nay to an exit strategy, a refi, a capital event. They might have to come to us first to get that approval. And then throughout the whole process, access to financials on a regular basis. We are on asset management calls with our operating partners monthly or quarterly, depending on cadence needed, and just essentially managing it in much closer than what an individual would be able to do on their own.
Yeah, well, and from your guys' standpoint, you've got significant more capital than just a regular investor normally would, too. So there's a fiduciary responsibility that needs to take place,
Right.
and again, it's your business, so that's like where what the investor that's investing with you is essentially paying for is like the peace of mind that someone's watching it and knows what's going on all the time. So that's pretty
Exactly.
cool. With I guess like other than shaking hands and I hear that you're looking at like 700 deals or so. Like, how do you determine that I guess maybe going into like the due diligence of the sponsor that you work with, like what sort of like goes into that, or what do you look for?
Yeah, I mean it's a process for sure, AJ. The people are harder to underwrite than any property, to be honest with you. So we're always looking for pedigree, right? Are these folks, this group, this sponsor, really good at their specific real estate sector that they're specializing in? You want to look at the credentials, right? How good are their track record? How long have they been in the space? How built out is their team? What's their AUM? Most of our operating partners are 500 million to $1 billion plus in assets under management. Built out teams, track record. When I say teams, that's critical, right? You think about acquisitions teams, asset management, back office, all of that has to run smoothly in order for investment to perform well. And any hiccup in any one of those roles or understaffed in any one of those roles, it starts to show in underperformance. And so all of that's important. We will oftentimes sit down and interview the asset managers, the acquisition teams, other folks that are in the back office to really try and get comfortable with everybody, right, AJ? And so it's a lot of interviewing, questions, analysis. It can take months, if not some operating partners we've vetted for over a year and a half before making any investments with them. And then a big one for us is communication and transparency. And so right out the gate, I'm trying to feel for how open is this group to sharing financials, sharing reporting. Is there a reason they don't want to, a hesitation? How slowly or how quickly do they respond to emails? How easy is it to get them to jump on a call? Like all of this stuff matters to us. And so a number of operating partners, may look great on the surface, but once you start to request a lot from them, you find out, what? This isn't going to work for us. If we're not going to be able to get clear transparency, communications, reporting, financials right out the gate, forget it. It's just not a good fit because we are looking for folks that are really good at what they do and are able to respond, within 48 hours to any type of request, give or take. If we want to see financials, reporting, projections, we'll sign an NDA and show it to us, right? And so that's the reality of how it has to work. From there, fee structure, alignment on terms, all critical as well. And so this is a bit of the operator sponsor due diligence that we do and the type of groups that we're looking to partner with.
Nice. Yeah. I mean, we do mostly multifamily and kind of like small stuff like you had said. I mean, I think, over the last year, we purchased like a 40 unit and a 30 unit, couple 10 units here and there and whatnot. But looking to get to that, like, over 500 AUM, I would say. So, I guess, so what you're saying is you're looking for someone that's like been in the business a long, long time and with, I guess, kind of like my inclination in the market in the last like 3-4 years as interest rates have risen, like how I know that in the market there's been a lot of kind of turmoil. I mean, how does that kind of factor into the current due diligence and maybe reevaluating some of your existing partners?
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Hey, let me ask you, what if tax season was actually exciting? I know, it sounds crazy, but not when you've got the right playbook. At mymoneyworksforme.com, we put together the Pro Tax Strategies playbook that real estate professionals use that you may not know about. You'll learn how to crush taxes with depreciation and rep status, how to stack smart write-offs from the Augusta rule to vehicles, and the ultimate wealth hack, 1031 exchanges and vacation rentals. It's free, it's powerful, and it's waiting for you at mymoneyworksforme.com, because your money should work as hard as you do.
Yeah, I mean, obviously, you and I were chatting a bit before we recorded, and I mentioned that we think this is the best investment time frame period, time to get in that we've seen since 2008 and 9.
Yeah.
And the reason why is because prices are down 30 to 40%. I mean, commercial real estate is on sale. It's having the biggest sale we've seen in a very, very long time. And so it's a great time to be buying.
It's like the biggest value add you can get right now, because you don't have to do anything. You just have to wait for interest rates to go down and the cap rates to go up. And all of a sudden there's a shit load of equity created.
If that happens, right? We don't want to underwrite to that, AJ. Yeah, we're always cautious about expecting interest rates to go down and expecting cap rates to go down. So if that happens, yes, there's going to be a flood of money coming into the market. You're 100% right. And we've seen that in the past. But today it's prudent, very prudent due diligence and asset selection. So we invest in a number of different asset classes, self-storage, mobile home parks, industrial, private debt, and also some multifamily. Some of the things that we're constantly looking for in a deal, I'll just start with positive leverage. Day one, we want to see the going in cap rate, 100 to 200 basis points spread above the borrowing interest rate. And so that is really hard to find just in today's market. So that right away eliminates a lot of deals. And the reason why we like that, AJ, you know this, but it will help create positive cash flow day one. We love cash flow. And so that's a big part of how we try and invest. Most everything we invest in provides 3 to 7% cash flow starting in the first year. And then it tends to grow to an average of 7 to 12% annually while we're holding. And then we want, average annual ROI call it in the low to mid teens, equity multiple 1.5 to 2.5x. So those are our projected returns, again, over about 5 years. That's what we're trying to find. And also making sure it's, somewhat realistic, right? You don't want to, I could take a pro forma tomorrow and change the assumptions and make it look much better in 5 minutes.
Yeah.
Right? That's what you got to watch out for that and make sure that we think there's some realistic assumptions on revenue growth, expenses, value add, NOI, you name it. And so there's a lot of underwriting, stress testing, downside scenarios we're constantly looking at. If all hell breaks loose in this market, something happens, how low can it go before you're really in trouble? And so that's it's how we think about things. I think it's very much risk first is how we look at almost every deal versus upside potential. And I could dive into any specifics, but let me shift back to you and see what that brings for you.
Yeah, I mean, risk is definitely something to mitigate as much as possible. Just making sure you get your capital back. I think maybe I'll rephrase my question of real estate's on sale now, and there's been like some turmoil with some sponsors. Like, is that a red flag if you're evaluating a new sponsor, or is it like kind of understandable? Or
Sure. I mean, it depends, right? Are they about to go bankrupt? Like, how bad has it been for them?
Yeah.
Versus did they make a few deals in 2021 with a certain type of financing and capital structure that didn't hold up? And they don't do that anymore. And they're going back to more, I would say, conservative fundamentals and structure. So there's absolutely a case of, hey, we got stung during the rate increases from 2021, 2022. But here's what we're doing now. And we've been doing this for 15 years. And that kind of story, absolutely, you can overlook some of those hurdles, those underperforming assets, or if they have some losses, we'll want to know about them for sure. What happened? Show us the deal. What did you do to try and solve it? Did you get a loan modification? Did you invest any personal equity back into the deal? Did you have a capital call? Like, what have you done to try and solve these problems? And then how does that deal compare to maybe some of the current deals they're doing in today's market, AJ? And so I hope that answers the question. Like, it's never just a red line, like, oh, these guys are out, unless you've heard and seen, there's just blood in the streets on everything they're doing, then we don't want to go near those groups either.
Yeah, that's understandable. Yeah. Well, what else do you do to like mitigate risk? I mean, so I hear a bunch of due diligence on the sponsor, diversifying across like different types of investments. Like, is there anything else that you would suggest to like mitigate risk?
Yeah, I mean, for folks doing this, there's some red flags that pop up right away that you can look out for when you're looking at deals, right? And so some of those are obvious, some of them aren't as obvious, but I can give you a couple thoughts on here's a red flag, right? One of them might be a really high acquisition fee. We've seen some groups lately charging 4% on purchase price. And you see a whole bunch of other fees built in, right? So what you want to look at is purchase price versus all-in cost. If that delta is too big, you're going to have to see, like, I'll give you an example. We saw a deal recently with a large multifamily sponsor. The delta between purchase price and all-in cost was like 35%, AJ. So I'm going to make up a number. Let's say purchase price was 50 million. Total cost was, what's 35%? Call it 65 million, give or take. Okay. That means the property needs to appreciate by $15 million just for you to break even, right? That's just your starting base case, because the all-in costs includes all these other fees and expenses and CapEx and you name it. And so we always pay close attention to that. So if you see a big delta, call it more than 5 or 10%, you're going to want to be a bit cautious.
So the overall property's value needs to increase by 15 million to like just to get your money back, right? Like if you're looking at the end of like what they're going to sell at in 5 years, it needs to go even further than that. It probably needs to go up to like 85 million, right?
Correct.
So one thing that like I do want to like say to the investors though is like that doesn't necessarily mean that your NOI needs to appreciate by that much, because your NOI is based off your financing, and you only have to, so your equity is typically like 25 to 35% of the money into the property, and then you've got 65% of the bank financing. So that 35% needs to essentially like double. So you may only need to increase it by 20-30% of the actual NOI, so like the rents and the income coming in.
Right.
So that's what from my understanding, and that's what the beauty, I think, of real estate is, that you get this leverage from the bank that you just don't get in other markets. Is that
100%?
Mark, do you want to like explain that again in maybe another way
No,
too? Like it's always good to hear it in a couple different ways.
Sure. Yeah, I think you're spot on. So as I mentioned, we're talking about asset value going up 15 million in this example in order for you to break even. But what AJ is also adding, which is equally important, is that doesn't mean the net operating income needs to go up by 15 million. That would be exorbitant, right? And so a quick way to look at that is, what's the starting net operating income? We look at the seller's trailing 12 financials, trailing 24 financials of the seller, and extrapolate out where we think it can go based on our business plan, what we're going to do to grow the net operating income, how quickly. And then that's where conservative versus aggressive assumptions come into play. But essentially, if you're looking for a lower risk investment, you're going to see net operating income starting, at the number pretty close to where it's already been at for the last couple of years, and maybe just going up a little bit, maybe 10 to 15%, maybe 20% over the next 5 years. Yeah. That would be a pretty conservative jump versus other deals, which maybe there's a heavier value add and you're going to renovate the units and you're going to do all these other things to manipulate NOI growth. You might see NOI growth go up 70, 80% over the next 5 years. But to get from here to there, you get it, it's a lot harder and you have to do a lot more, and there's more execution risk to be able to create that value than maybe the lower NOI growth deal. And so if that is the business plan, you should be rewarded with a higher return because you're taking on more risk. And so that's what it comes down to for us. Yeah. We always look at risk and reward.
So actually that kind of brings a point up. Like, we stay far away from developments, and the term that you mentioned there was execution risk. And that for us, like, just we foresee developments like the unknowns with the city, the permitting. There's just a ton of stuff with development that execution risk just goes exorbitantly higher than purchase and kind of rehab. And typically what we see on like those deals is like the rewards are not compensatory with the amount of risk that's associated with it. Is that kind of like what are your thoughts on kind of development and those deals?
I think you said it perfectly, AJ. Yeah, just to kind of comment quickly, we don't do a lot, very little, if any, development, new construction deals. Again, we like to invest for cash flow. And of course, there's no cash flow if you have a deal that hasn't been built yet and isn't producing income. Construction costs have gone up. We've seen, as you have, more deals miss their projections than those that actually hit them or beat them. Yeah. From a time delay and a cost overrun standpoint. And then you also have the cost of borrowing on construction loans is really high. And so there's a reason why construction starts are down now, 40, 50% on multifamily across some of the Sunbelt regions. It just doesn't pencil anymore, guys. It's too expensive to build. Again, I'm speaking generally. There's always exceptions where it can make sense. But for me as an investor, those types of deals tend to have a slightly higher projected rate of return, AJ, but they come with, 3-4 times as much risk, maybe 5 times. And so the risk reward is out of line, in my opinion, right? If I'm going to take on development risk, people probably are going to scream at me, but I want to see a 3X, right? That's what I want to see.
For sure.
I don't want to see a 2X. 2X is what we're underwriting on some of our value add deals that have cash flow day one. And so that's how I look at it.
I think that investors get caught up with, and it's like the sexiness of it, right? Like, I want to be in this brand new building that looks, awesome, and these architectural drawings that look amazing. Like, oh, of course this is going to work. This is going to be incredible. So
sure. Yeah.
I've always
overruns, time delays, expensive debt. It's a tough uphill battle.
Yeah. One thing we may have not talked about with risk and risk mitigation is, what about markets? Like, these sponsors, I'm assuming, operate in different markets. I think you said you want to pick sponsors that are super familiar with their market or have been there a while. But like, do you stay away, like, if you see a certain market not going in the way that you want? And the reason I'm asking is we operate in Portland, and our market right now is significantly, nationwide, we're probably a little bit down. But again, that makes for a good buying opportunity. But I'm curious kind of your view and how you calculate that risk, or how you look at it.
Yeah, I mean, markets are obviously very important, AJ. We all know real estate is market specific, and it can adjust in 5 miles. It can be in a completely different market, even less, right? So, but what we also look at, because we invest in multiple real estate sectors. And so, for example, a mobile home park isn't going to be in the same type of market typically that a apartment community might be that we're looking at. And so we are a little bit more market agnostic depending on asset class. So for mobile home parks and self-storage and some industrial, not all industrial, but some, we're typically in secondary and tertiary markets. Why? Because we're looking for cash flow. We're looking for affordability for housing when it's mobile home parks, for example, or even some apartments. But generally speaking, we are investing in the Midwest, the South, the Southeast. We're looking for markets where, honestly, on apartment communities, AJ, if looking at a 2-bedroom, the rent is usually $1,000 to $1,800 a month. We're not investing for $3,000 a month type communities. Mobile home parks, we want to make sure we are within close proximity to a major MSA, usually 20 minutes. You want to have a good, strong 500,000-ish population center, not too far away. You want to be able to make sure that the community you're looking at is affordable based on the local area median income. How much money do folks make in this area? What is the cost of living and the cost of the rent that they're going to pay? And then, of course, look at comps and try and determine supply, right? That's a big one for us, especially with self-storage. You have to be very careful in self-storage. If a local community is oversupplied, we'll stay away right away. That's a big red flag for us. We won't touch it because it's going to put a hamper on rents, occupancy, all your projections. New supply can crush old supply performance on self-storage very quickly overnight, and it could take years to recover. And so that's a bit more, down to the granular micro market, this specific zip code, how much storage supply is there versus vacancy, occupancy, demand, and how easy is it to build new. And self-storage, for example, is one of the easiest. Real estate sectors to build new, and the new shiny one competes with the old shiny one. Just got to paint it. And so there's not much to it from a differentiating factor versus apartments. You'll see a big disparity in price on a 1980s apartment versus a 2020 build apartment, right? The rents will be staggeringly different.
Yeah,
but that isn't always the case.
2030, sometimes 50% different. Like, can be huge.
Exactly.
Well, very cool. Well, is there anything else on risk that you maybe want to talk about, or on fund of funds, before we move on to the last 4 questions?
I mean, some of the things you look out for, again, going back to underwriting deals, some red flags. I know a lot of our folks like to hear about what we're staying away from, but capital structure, right? If there is preferred equity ahead of common equity, especially if the amounts and terms are undisclosed or subject to change, which we see on all these deals, we just tend to stay away from that, AJ, because it just acts like more debt and it increases the risk for the common equity, but it also increases the return for the common equity. And so that's why a lot of operating partners will have preferred equity ahead of common. But we tend to stay away from that type of structure. And then as far as, debt goes, 60, 70% max is pretty good. We have some operating partners that don't go above 50 loan to value, I'm talking about. And fixed rate debt for at least 5 years is what we're pretty much almost always focused on as well. And so that allows you time if something should happen where you're not forced to sell at the wrong time. That's the reality of how you lose money in real estate, is forcing to sell at the wrong time.
Yeah. Yeah. If you can stay the course for wait for the rents to come up, or, get some, keep doing your value add plan or whatever you need to do to make the cash flow. Like, holding on to real estate over the long term is where the benefit is. We mostly operate in like forced value appreciation. So typically our stuff's, 6 months to 2 years to kind of get stabilized and then wait it out and then hopefully sell for a good price, and unless interest rates keep going up.
Of course.
So
we'll see.
Yeah, we shall see. It's it definitely seems like inflation is starting to creep up again. So it's not looking the best. But
right.
My brother and I have always said, like, as long as you keep buying real estate, even on the ups and the downs, you'll always hit the bottom. Yeah, you might hit the top. But as long as you keep buying, you're still it's like dollar cost averaging in the stock market. So it's like, as long as you keep putting stuff together, keep doing it, and should be good. All right. What do you think? You ready for the last 4 questions?
Yeah, let's do it.
Okay. So first one, what's one piece of advice you would give to your 25-year-old self?
25-year-old self. So I think it would be start building the network earlier. I know that might sound cliche, but it's so important in our business, who you surround yourself with, who your investors are, who your operating partners are, and, just build it as early as you can and take good care of those folks throughout the process, right? So focus on people is a big one. I think I would have started that earlier for sure.
Yeah, that's good. I mean, I know that my brother and I have had several mentors during our years. And then also our dad was in real estate too. So very similar background story. But yeah, keeping those people that you can call and you don't have to pay a lawyer to give you that advice is pretty awesome sometimes. Yeah. All right, next question. What was your first entrepreneurial endeavor?
Oh, gosh. I mean, the first one that pops up is buying a condo in Los Angeles at probate court, not knowing what the heck I was doing. So, it's a great story, but I was very young and didn't know what was going on. I thought I already owned the property and I was there to just get the deed. And sure enough, I'm at the courthouse steps and the judge asks if anybody wants to bid higher than what my bid was. And I didn't have any more money. And so 2 guys raised their hands and they essentially were outbidding me. But something happened. They went up to the judge's desk and their checks were made out inaccurate. And so they didn't qualify. And then I'm sitting in the elevator leaving and I got the title, and sure enough, one of the guys is standing right there. And he's like, "Oh, you're that kid that got the condo." He's like, "You just lucked out, buddy." So,
wow.
You hear that, you're like, "Oh my gosh, I don't even know what's going on. I thought I already owned this thing." So,
well, explain to me how did you think you already owned it?
My real estate agent didn't know what he was doing either, AJ.
Yeah. Okay.
So he said, "Oh yeah, we just got to go to this meeting with the judge so he can give you the title." And so you show up to court and there's 20 people there, and you realize we were just bidding on it. We hadn't actually won yet. And this was the final process to get all the
Wow.
bids, one more chance or something. Again, it was 20 plus years ago. I don't remember all the
Yeah.
details, but he was shocked. He didn't know what was going on either.
Wow. Yeah, we've got a contact that's done a lot of auction bidding and that sort of stuff, and he buys his business is he buys like the first right of what was it, redemption rights. So
Okay.
if you pick up a property on the steps, the original owner has 6 months to redeem it for that price, and so he picks up the
Sure.
redemption rights, lets the people go fix it up or do whatever, and then is like, "Hey, you know what? Look, this looks pretty good. I think I want to buy it for what this is." And it's like, whoa,
Sure.
yeah.
Yeah.
So
Lots of
if you're
strategies.
buying auctions, make sure you get the redemption rights from the previous owner.
That's good.
All right, next question. How has your formal and informal training shaped your journey?
Yeah, I would say the formal part, just being working in corporate finance, we touched on earlier. That was a big part of analysis, underwriting, pro forma projections, stress testing deals, sensitivity analysis has all been a big skill that I've learned through some of that formal education, AJ, and working in corporate finance for a number of years. And then informal, just very hands-on, also through my family and their experience in real estate, my father specifically. But, if you own and manage rental properties in your 20s, you're going to be busy just managing the tenants, leasing, posting them for rent, working with lawyers on the right legal terms, evicting, you name it, right? Posting 3-day notices. You learn all that stuff. Just dive in and get going and figure it out, right?
I mean, back at the time you were doing it, it's like holding open houses and giving it to the most qualified tenant.
100%. And one thing I learned, if you have a very small room, put an air mattress in it. It makes it look much bigger. Right? Don't rent it if it's empty. Put some furniture in there. It honestly makes rooms and spaces look much larger, and they'll rent much quicker.
Huh. Interesting. Very cool. All right. Last question. What was your biggest mistake and what did you learn?
I don't know if there's a specific one, honestly, AJ, that comes to mind. I'll say this, right? Real estate is a hard business. It just is, right? There's always a challenge that we're solving. Recession in 2008 and 9 was a big one. There was no financing available. What do you do? Right? Figure that out. Good luck. And then values and rents came in. They started dropping in certain markets. What can you do? You got to start cutting expenses, right? There's challenges all the time in this business. We've had a duplex burned down while the tenants are in there. What do you do with that, right? Your property manager calls you and says, "Hey, we had a fire," and you think they're joking, but they're not. It's like very real all of a sudden.
Like, oh, was it just a stove fire?
Yeah, no, total loss. And so, in that case, we hired a private claims adjuster, signed over a power of attorney, and had them go fight with our insurance company. And they got us a lot more money than we would have gotten on our own. And so these kinds of little things you learn, that was a big problem that we solved and ended up with a really strong return for our investors there. But obviously there's been challenges all the time, AJ. A global pandemic, fastest rate increases in 40 years, all the challenges today, tariffs, war, inflation. I just think you gotta have a strong spine. You got to be able to stomach these kinds of ups and downs. And you're in the problem solving business. And so, if something pops up, just research the heck out of it. Try and figure out who's dealt with this before. Let me go talk to them, hire a consultant, do what you got to do to figure it out. How do we solve this? I mean, most things that come up today aren't really new per se, right? There's folks that have been there before, and try and lean into their experience and guidance whenever you can.
Yeah, and some people have made jobs out of it too. Like the insurance claims adjuster you were talking about. Like that does it so much that he's like, this is a job. So a lot more people have some different knowledge. And like you have much more knowledge of doing the fund of funds and asking sponsors how to, create new classes and a little bit more preferred returns and stuff. Like not something we've done. But
Sure.
Well, Mark, it's been a pleasure having you on. Appreciate the knowledge that you've shared with us and our audience. If our audience does want to get a hold of you or learn more about SMK Capital, what's a good way to get a hold of you or get in contact with you?
Yeah, I'd say if you're interested in learning about our passive investments, some of the real estate sectors we invest in, go to our website. It's smkcap.com. You can sign up to join our investor network and get access to our offerings when we have some. And if anyone's in Bend, Oregon, let me know. Happy to reach out and connect, grab lunch, go for a hike, whatever you want to do. Outdoors, very beautiful here. This is home for us. So.
Yeah. If you're in Bend, definitely float down the Deschutes right in downtown, right? In the summer.
Exactly.
That's always fun.
A lot of fun.
Well,
exactly.
Yeah, it's fun having another person on from Oregon as well. So,
my pleasure, AJ. Yeah, thanks for having me.
Yeah, thank you very much.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.